Hi everyone, my name is Vansh Shah, and on behalf of our group, I will be opening this presentation on the book You Can Be a Stock Market Genius by Joel Greenblatt. Before we move into core learnings, we will briefly set the context by explaining what the book focuses on and who the author is. At its core, the book is about finding value in areas of the market that are usually ignored. Instead of popular or widely tracked stocks, it focuses on situations that are complex and uncomfortable to analyze, where few investors are willing to put in the effort. The book is centered around special situations investing. It studies opportunities created by corporate events such as spin offs, mergers, restructurings, and bankruptcies. These situations are often misunderstood or avoided, which is why pricing inefficiencies can exist. One of the key ideas discussed is systematic mispricing. In many of these cases, institutions and analysts either misjudge the situation or are restricted from participating. This creates gap between price and value, which disciplined investors can potentially take advantage of. The approach in the book is based on logic and discipline rather than prediction. It emphasizes a repeatable research framework focused on understanding the situation clearly instead of chasing market trends or short term free movements. Coming to the author, Joel Greenblatt is a well known value investor and hedge fund manager. He is the founder of Gotham Capital and has built a strong long term track record by consistently applying value based principles. He holds an MBA from the Wharton School and is also a professor at Columbia Business School, where he teaches practical investing concepts such as valuation, balance sheet analysis, and special situations, combining academic rigor with real world application. In this book, he has also written The Little Book That Beats the Market and few other investing titles. With this background in place, the foundation is set. Our next presenter will now take this forward by discussing the key learnings and core ideas from the book in detail.
Hello, I'm Virti Khandur. Let's understand rights offering. In a rights offering, a company gives its existing shareholders the option to buy shares in a new spin off. The important word here is option. Investors don't have to act, and most of them don't. These deals are usually complicated, not very well explained, and frankly, a bit boring to read. Because of that, many shareholders either ignore the rights or let them expire. Institutions also avoid them because the size is small and the structure is messy. That's where the opportunity comes in. When fewer people participate, fewer shares get issued. So the same business is now divided among a smaller group of owners, which increases upside for those who actually step in. The big idea Greenblatt highlights is this. Rights offerings don't work because they are exciting. They work because most investors do nothing. If you are willing to understand the structure and see what insiders are doing, you can benefit from everyone else's inaction. Now let's see how this played out in the Liberty Media case with real numbers. Telecommunications was worth around $15 billion with roughly $6 billion in equity and $9 billion in debt. It decided to spin off Liberty Media using a rights offering. Shareholders received one right for every 200 shares of TCI. To get one Liberty share, an investor had to give up 16 shares of TCI plus one right. Since TCI was trading at about $16 per share, this meant Liberty was being bought at roughly $256 per share. On paper, this looked terrible. Liberty was small, illiquid, and reported losses. Analysts openly said the deal wasn't attractive. As expected, most investors stayed away. But here's what they missed. At most, only 2 million Liberty shares could be issued, but only 36% of rights were exercised. That meant only about 7 lakh shares were actually issued. The assets of Liberty, worth around $600 million, were now spread over far fewer shares. Any unsold equity was replaced with $250 million of preferred stock that carried a 6% rate, required no cash payments for 15 years, and had no upside participation. This quietly boosted the upside for common shareholders. The strongest signal came from insiders. John Mellon exercised his rights and also held options for 1 lakh Liberty shares at the same $256 price, giving him a huge incentive to make Liberty successful. Within less than 2 years, investors who participated made nearly 10 times their money. The key lesson is this: the deal was designed to look unattractive. Those who understood the structure and followed insider behavior were rewarded.
Hi, I'm Yash, and I'm going to be covering the demerger portion of the presentation. Now, first of all, what is a demerger? Now, when companies decide that they want to run different segments of the businesses separately, that's when a demerger occurs. So what happens during a demerger is that the existing shareholders of the company get shares of the demerged segment. So it could be a situation where, let's say, a segment A was profitable, had a profit of 100 crores, and segment B was loss making of, let's say, 20 crores. So net profits became 80 crores for the whole conglomerate. So when this happens, and especially if both the segments are in different industries, it is very hard for the investors to value this business, because of which, again, the valuations that segment A deserved, it's not getting it. Sometimes it's not a whole demerger. Sometimes it could be a partial spin-off where the company decides to keep some stock of the demerged entity even after the demerger. So now we need to understand why there is an opportunity for us in the first place. Think about it. The large fund houses don't really invest in very small businesses. Again, a loss-making business, or even if it is not loss-making, even if it is a very small segment of the business that is getting demerged, that just might be too small for large fund houses to invest in. Because of which, what they do is that even if they invested in the entire company before the demerger, they end up selling it. Another thing, now, before the demerger happened, a lot of investors didn't have a choice what segment to invest in. So if they didn't really want to invest in segment B, they could just sell it, which again creates an opportunity for us, because after the demerger, the prices of the stock segment B go down, which again make it really cheap for a smart investor to look for. Sometimes it's not just the segment B that we want to look at. Sometimes it's that segment A's financial potential is truly unlocked after the demerger, because there is not a loss-making segment on its head that is bringing the valuations down. We have to look at it in terms of if it is the right pick for us or not. So one of the things that we could look at is management ESOPs. So if the new management of the demerged entity is getting sufficiently incentivized so as ours and their intentions are aligned, that is a really good news for an investor. Another thing to look at is how the assets and the liabilities are going to be distributed post merger. Again, another thing to look at is the financials of both the segments, or all the segments that are getting demerged, and the parent company before the demerger happens, so that we know what we are getting into. Again, as I said before, don't just look at the spin-off company, also look at the parent company, because again, that company's potential could be unlocked post demerger. Now I'm going to take you through a couple of case studies so as we understand how to look at a demerger. Right. So the first example I have for you is Host Marriott and Marriott International. So before the demerger happened, they were running the business together. Host Marriott owned all the assets and the all the hotels that the business had. But because of a down cycle in real estate, they weren't really able to sell all of these hotels, because they had tremendous amount of debt on them. Marriott International, on the other hand, used to handle just the management part of the business. And that was the business that was actually responsible for bringing in revenue. Now, post demerger, what happened was all the debt and all the assets, that is all the hotels that were there, were distributed to Host Marriott. And essentially what happened was that Marriott International was free of all of the debt, and well, was a sustainable business. Now, what's interesting though is even after the demerger happened, Marriott family still held 25% of both Marriott International as well as Marriott Host, which does kind of make again our intentions the same as the promoter family. Another thing was that the management was sufficiently incentivized. Also, Marriott International was to provide $600 million of credit to Host Marriott so that it could sustain itself. So the demerger was announced in October 1992, but the filings were done by July 1993. So it's not always so easy to invest in demergers, because sometimes delays do happen. The record date was in September 93, and the host was listed at $5 per share. But it also had, again, all of the debt, so that is $25 of debt per share. So that brings us an asset value of 30. Now, assume there is a uptick in the hotel business and the hotel market, so to say, so that host Marriott is able to sell these hotels at a premium of, let's say, 15%. Now assets again rise by 15%, which gives us 34.5. Now because the debt still stays the same at $25, that creates our equity at $9.5 per share. So because the share price before was $5, and when I say before, I mean right as you invest. So just post demerger, it was $5 per share. And if the asset prices go up, your share price would become 9.5. So that is a 90% return. Now, obviously, the assets could lose their value further, but since the management was involved and so were the promoters, and the business didn't really have a cash crunch because again they were getting $600 million of credit, I think that this was a good bet to make, because again you were getting very high returns because of the debt in the first place. Now, another example we have is Stratex Security and Briggs and Stratton. So the combined business, Briggs and Stratton was an engine manufacturer for automakers, and Stratex Security used to make auto locks, which was responsible for about 20% of the combined business. Now, Briggs had a market cap of $1 billion. So the demerged entity was, you could say, around $100 million. So again, for large fund houses, quite a bit small. Now, what is something that we again look at in terms of a demerger is if the management is getting incentivized. Now, 12% of the new company, that is your Stratex Security, was reserved for its employees and the management. So now the record date was 27th. Now the record date was 27th Feb, and EPS for Stratex Security just before the demerger was $1.18. Now, because it was an original equipment manufacturer, we could look at other OEMs so that we could get an idea of what kind of PE they were getting. So the kind of PE they were getting was about 10. So you could say the share price was going to be $11.80. What was interesting though was that before the demerger, Stratex Securities was a supplier to both GM as well as Chrysler. And in the demerger document, they specified that they were about to make a deal with Ford, which would make it the second largest customer for Stratex Security. So second largest means that it would be higher. It would have a higher contribution to revenue than Chrysler, which was at 16%. So even if we take just 16%, that means the revenue is going to go up by 16%. So another thing is that it being a supplier to companies like GM, Chrysler, and now maybe even Ford, it could trade at a premium in terms of PE. So it could trade at, let's say, at a PE of 12 instead of 10. So after the demerger, Stratex started trading at $12. So it was at the end of February. And by November, it was trading at $18. So in about 8 months, you basically got returns of 50%. Another example I have here is Sears, the company that is known for its departmental stores now. So at the time, it had two other businesses as well. So it had Dean Witter and Allstate, which was an insurance company. Before any of the demergers, Sears had already sold 20% of Dean Witter at $37, and Allstate was trading at about $39. And sorry, $29, and Sears was at $54. Now, if the share price for Sears is $54, Dean Witter is 37 and Allstate is 29. Another thing is that Sears had a total number of shares of 340 million. Now, in the demerger document, they said that the swap ratio was going to be 0.4. So essentially, for every 340 million shares that Sears had, total number of shares that Dean Witter was going to have post demerger was 136 million new shares. So, and in terms of the worth of share that the existing shareholders were going to get post demerger was, again, you can see here 0.4 times 37. So you can see here worth of Dean Witter shares you get, that is 0. If you can, yeah, so 0.4 times 37, which comes out to be, well, $14.8 worth of share. And because total share price for Sears was 54 and All Star was 29, and again you were getting 14.8 of Dean Witter, total essentially the real share price you could say for Sears was $10 more or less. But another thing to look at is that this $10 also included about $5 combined for Sears Mexico as well as Sears Canada. So essentially, for Sears US, you were getting all the departmental stores for about $5 per share. So now the revenue that Sears had in the year prior to the demerger was $27 billion. So for 340 million shares, that comes out to around, yeah. So it comes out to around, I just give me a second. Yeah, it is $79.4 per share of revenue. Now, JCPenney, being a peer of Sears, had a per share revenue of $78. So, pretty similar, but it also traded at $44. So it kind of does give us an idea that Sears was available at a very cheap valuation pre-demerger. So again, Sears post the demerger, again combined with All-Star, because All-Star wasn't completely demerged yet, it started trading at a 50% high in about 5-6 months. So again, a tremendous amount of value to be created for a smart investor. So I think that is it for demergers from my end. There are certain types of demergers that also include rights issues, but that is something that my another participant of this presentation will take. Thank you.
Move forward to the next concept, which is risk arbitrage, also referred to as merger arbitrage, and how investors attempt to profit from mergers. Arbitrage is based on a simple opportunity called as the spread. To understand this, imagine a company that is trading at $25 before any deal is announced. Once a merger is announced, the acquiring company offers to buy its share at $40 per share. After the announcement, the stock does not move straight to $40. Instead, it trades somewhere in between, for example, $38. The difference between the market price of 38 and the offer price of 40 is called as the spread, which in the case is $2. The goal of the risk arbitrator is to capture this spread if the deal successfully closes. What the arbitrator is doing here is buying the target company's stock after the merger announcement. The reason this opportunity exists is because the stock trades below the offer price due to uncertainty. There are two main risks involved. The first is the deal risk, which means the deal might fail for reasons such as regulatory issues, financing problems, or last minute changes of mind. The second is timing risk, because even if the deal goes through, it can take several months to close and money remains tied up and during that period. If the deal does close, the investor captures the spread as profit. The process of risk arbitrage follows a two-part journey. First, a merger is announced where one company offers to acquire another at a premium price. This creates a spread because the target company's stock jumps but still trades below the offer price due to uncertainty. The arbitrator then buys the share at lower market price, effectively betting that the deal will close. From here, there are two possible outcomes. If the deal closes, the acquisition is completed and the investor receives the full offer price, resulting in a profit equal to the spread. If the deal fails, the stock price typically collapses back towards or even below the pre-deal price, leading to a significant loss. This reward reality is clearly visible in the Ryan Insurance Group example. In July 1982, Combined International agreed to acquire Ryan Insurance for $34 per share. An arbitrator buying at around $32 was aiming for a $2 gain, which worked out to be a 6.25% return. However, the downside was severe. If the deal failed, the stock could go back to its pre-deal price of around $18, implying a potential loss of $14 or more than 40%. During the shareholder meeting, a last-minute crisis emerged when the founder of Combined Potential hesitated to step down, putting the deal on the verge of collapse. Although the deal was eventually salvaged and closed later at the same day, the example highlights the core reality of risk arbitrage, where the potential loss often dwarfs the potential gain, and it's truly not over until it's over. So now that the idea of risk arbitrage is clear, let's move to the next related concept, which is merger securities. In a merger, shareholders are usually paid in cash or shares, but sometimes the acquiring company uses other kinds of securities as the part of payment. These are called as merger securities. They are non-cash instruments issued by the acquiring company, and their final value depends on how the market prices them after the deal. These can take several forms such as shares, bonds or debentures, warrants, and something called as contingent value rights or CVRs. The way this typically works is simple. When a merger is completed, shareholders of the target company receive these securities instead of full cash. Most shareholders never wanted these instruments in the first place because they originally invested in a completely different business. So the moment they receive them, they try to sell them immediately. This creates forced selling, and because the selling happens without much analysis, mispricing appears. The mispricing is where an opportunity opens for informed investors. A real world example of this is Viacom and Paramount merger. In this deal, Paramount shareholders did not receive only cash, they received a combination of Viacom common stock, CVRs, and exchangeable debentures. Among these, one of the most interesting combinations was Viacom stock and along with a CVR. The CVR was designed to protect value. If Viacom stock traded below $48 after 1 year, Viacom would compensate the investor for the difference. So downside was limited because the value was protected, while the upside remained open if the stock moved higher. Shortly after the merger, investors could buy one share of Viacom plus one CVR together for $37. That meant that there was a guaranteed value of $48 after 1 year, translating into a return of over 30% on an annualized basis with limited downside risk. The entire opportunity existed mainly because most investors receiving these securities did not want them and sold them quickly, without caring about their actual structure or payoff. So, the key takeaway from this slide is that merger securities are often ignored and mispriced, not because they are bad, but because they are unwanted. And for someone willing to read and understand them, they can offer very attractive risk reward setups. With that understanding of how merger securities work and why they can be profitable, our next speaker will take the discussion forward from here.
I am Zalak and I will be covering next few slides of the presentation. When markets hear the word bankruptcy, they usually panic, prices collapse, headlines turn negative, and investors assume the business is finished. But that reaction is often wrong. Most of the time, bankruptcy is driven by fear and mispricing, not by broken businesses. Companies don't fail because customers disappear overnight. They fail because the balance sheet can't handle the pressure. Common causes are excessive debt from past buyouts, aggressive expansion, temporary cash flow mismatch, or a tough economic cycle. The operations often continue, employees still work, customers still buy. That's why bankruptcy does not automatically mean a bad business. And this is where the opportunity lies. Markets hate complexity. Legal processes, restructuring plans, and uncertainty push most investors away. As a result, assets get sold indiscriminately and prices fall far below the intrinsic value. Greenball's core insight is simple. When a good business is over leveraged, bankruptcy can actually reset the capital structure. Old equity may disappear, but new securities are created, often owned by reluctant creditors. For investors willing to do the work, that complexity creates value. Bankruptcy isn't always the end. Sometimes it's where mispricing begins. This slide shows one of the Greenbell's most famous bankruptcy case studies, Charter Medical Corporation. At the core, this was a profitable psychiatric hospital business. The problem wasn't operations, the problem was leverage. Charter was taken private in a leverage buyout and loaded with about $1.6 billion of debt. When industry conditions tightened, the cash flow were not enough to service the debt. Not because the business stopped working, but because the balance sheet was stretched too far. That pushed the company into Chapter 11. Once bankruptcy happened, the market reaction was brutal. Old equity was wiped out, the stock was treated as worthless, and ownership shifted to creditors like banks and bondholders who never wanted to own a hospital business in the first place. Now look at the transformation. After restructuring, roughly $700 million of debt was cut. That alone changed everything. Interest burden dropped sharply, operations stabilized, and most importantly, the value that was previously crushed by debt shifted to new equity. Let's think in simple numbers. Before bankruptcy, a business earning say $200 million in operating cash flow, but carrying $1.6 billion of debt looks uninvestable. After restructuring, if debt falls to around $900 billion, the same cash flow suddenly supports equity value. Even at a modest 6 to 7x cash flow, the business could be worth over $1.2 billion. But because the new shares were ignored and dumped by reluctant creditors, the stocks traded far below the value. This is what Greenbelt called orphan equity. Good businesses, new securities, no natural buyers. The lesson is simple. Bankruptcy didn't destroy value here, it moved it. And investors willing to do work got paid for stepping into complexity. Restructuring is really a financial reset, and for investors, the real work starts with the right question. Yes, debt overwhelms cash flow and the balance sheet breaks first, but the business often continues to operate. That's just the setup. The first key question is simple. Is the business still viable once the debt pressure is removed? If operating cash flow are positive, value likely still exists. The second question is about control. Who owns the asset after restructuring? Old equity usually disappears and value shifts to creditors who receive new shares or claims. The third question is where opportunity lies. Where does value migrate in the capital structure? Often into new equity that few people want or understand. Investors who focus on these questions instead of headlines can spot mispricing. Restructuring doesn't kill value, it moves it to the different place. Greenman Brothers is a classic example of buying a hidden business for free. At the time, the stock was trading below $6 per share. The market saw only a boring, low margin distribution business and ignored everything else. Now, look at the numbers. The distribution business alone had over $8 per share in tangible book value. That was mostly cash, receivables, and inventory, and almost with no debt. Even if you apply a 40% haircut, $8 drops to about $4.8. That's your downside. So at a purchase price under $6, you are risking roughly $1 per share in a first case scenario. Now the upside. Inside this dull business was Noodle Key Doodle, a fast growing educational toy retail concept. At the market price, its implied value was zero. You are effectively getting it for free. Then came the catalyst. In 1995, the company announced a restructuring and the sale of the distribution business to fund Noodle Key Doodle's expansion. Once the market recognized this, the stock was re-rated to around $10 to $11. From under $6, that's roughly an 80 to 100% return. The lesson is simple: protect the downside with hard assets and let mispricing create the upside. With that, I'll hand it over. Now, the next presenter will take you to the further topics.
Welcome to slide number 10. Many of you might assume that billion-dollar portfolio managers have an unbeatable advantage over you. However, the reality is that their massive size is actually a significant handicap. Let's look at the math. A manager running a $12 billion portfolio can't just buy a few shares of a small company. To move the needle on their returns, they must invest hundreds of millions into each positions, which forces them to own between 50 to 200 different stocks. Even legends like Warren Buffett and Peter Lynch faces this issue today. Their methods are now difficult to replicate simply because they manage billions, forcing them to buy only massive companies. But you have a distinct edge. As an individual investor, you are not forced to buy hundreds of stocks or stick to the most widely followed companies. This flexibility allows you to exploit opportunities that big money physically cannot touch. Your true edge comes from applying your energy to areas that are not closely followed by the army of Wall Street analysts. By looking for situations that are too small for institutions, you face less competitions, which drastically increases your chances of finding inefficiently priced bargain. Now that we have an edge, how do we use it? So here are the rules for finding hidden treasures. First, success requires doing your own homework. You cannot rely on luck. Without basic knowledge, you simply can't tell a great investment from a bad one. The goal is to find situations where the odds are unfairly stacked in your favor. These opportunities usually exist in areas where Wall Street ignores, meaning there will be little media coverage to guide you. Extraordinary profits are not a reward for taking massive risks, but rather the justly deserved pay for doing your homework. For example, instead of buying a tech stock because it's trending on Twitter, you read the annual report of a boring manufacturing company and realize that they possess more cash in the bank than their entire stock market value. That is the homework paying off. Next, focus on the connection between the price you pay and the true value of the asset. We call this looking down. You must focus entirely on limiting the downside. If you ensure you don't lose money, the upside usually takes care of itself. For example, it's like buying a house for 20 lakh when the lumber and land alone are worth 30 lakh. Even if the housing market drops, your downside is protected by the raw value of the assets. Next, just say no to analysts. You must learn to say no to the stockbrokers, and analysts are often incentivized to issue buy recommendation to generate commissions or protect banking relationships. It is safer for them to be wrong within a crowd than to risk being wrong alone, which leads to a lack of independent thinking. Finally, be selective. Instead of holding a vast array of stocks, pick your spots and invest only when you have a clear convictions.
Hi, I will be covering the AI part of the current affairs section of the presentation. So, if you look at AI, it's not just creating a revolution in the tech industry, but it is also creating demand for more energy because it requires data centers. So, for example, just before ChatGPT was released in early 23, just before that, the forecast for energy demands in 2030 for India were 661 trillion watt hours. But now that forecast has been revised to 817 trillion watt hours. That is a 24% increase in just 2 years of the AI revolution. But what is India doing in terms of AI? So Reliance has committed $11 billion to create AI infrastructure in India, and it aims to develop 1 gigawatt of AI data centers inside the country. A mid-cap company, that is Coforge, has acquired Encora, a Silicon Valley startup that creates agentic AIs, because firms nowadays have realized that they cannot scale up their proof of concepts to sizable part of the business chain. So they need agentic AIs, and that is where Encora comes in. But in terms of the R&D, we're still not there yet. In terms of patents all over the world that are launched every year, India only contributes to just 1% of them. Annual private AI R&D in terms of GDP for India is just 0.03%, whereas it is for US at 1.68%. And then you consider the GDP of US, you realize the amount of money that they're spending in terms of AI R&D over there. Another thing that is happening now is that some investors are worried, what if AI ends up being a bubble? So, because India doesn't really play such a big role in AI in the world, especially not as big as, let's say, US or China or Taiwan. So investors are seeing India as a diversification edge. Another development in the AI world is that companies like Meta, for example, are giving designs to data center makers as to how they want their data centers to be, but they don't take off that debt that takes, to build the data center. They don't take that debt over their balance sheet. They lease it in 4-year period. So, for example, the first time that they did this was in 2024. So, a 4-year deal would end in 2028. They've already signed one, so one more deal would end in 2032. Whereas the data center maker is stuck with a deal like that till 2049. Another thing in terms of AI's impact on India is that in the tech industry, most amount of hirings are happening in GCCs now instead of our IT service industry. Moving on to the next topic of current affairs, we have IPOs. So IPOs are initial public offerings. So the first time a company comes to the public market to not only get investment, but also give a chance to the public to hold some part of that company. In the last 12 months, there have been 344 IPO listings and 1.6 lakh crores has been raised. But if you look at the returns, the median return of these 344 IPO listings has been 0%. And yet the mean return has been 14.3%, which seems respectable. This is because there have been some strong performances from the outliers. For example, 72% of these companies were listed with initial gains, but now only 50% of these IPOs are trading above their offer price. In October alone, 53 IPOs were listed. But in terms of the sectors that are getting the most number of IPOs, 25% of these 344 companies were a part of NBFC sector, 10% from capital goods and 9% from technology. So this is it from my end. The another participant would take it from here. Thank you.
Let's break down what just happened with tariffs and why it matters. Firstly, the change. Mexico has imposed tariff going as high as 50% on selected imports. For India, this is not a marginal issue. Roughly 75% of Indian exports to Mexico are now impacted, especially sectors like automobiles and electronics, where margins are already tight. A 50% tariff doesn't just reduce competitiveness, in many cases, it makes export unviable overnight. Now, the obvious reason why now? There are three overlapping reasons. One is political. This move is linked to broader US India strategic negotiation where trade concessions and pressure points are being actively used. The second is economic pressure. Mexico is trying to shield domestic industries from sudden import sources. Tariffs are a fast, blunt tool to protect local producers when demand or employment is under stress. Third is strategic. This fits into a wider shift towards regional trade blocs and FTAs rather than being open multilateral trade under MFN policies. Now comes the real analysis. Who actually bears the cost? Not government, mostly exporters, supply chain, and eventually consumers through higher prices. Which sector gain or lose? Domestic manufacturers in Mexico gain short-term production protection. Indian exporters lose pricing power. Some supply chain may reroute, but that takes time and capital. And the most important question, is this temporary or structural? That final box on the slide gives the signal this is not just a tariff story. It reflects a larger global shift away from globalization towards fragmented, region based trade. More protection, more negotiation, less predictability. For markets and business, this means higher risk premium, supply chain redesign, and fewer assumptions about free trade going forward. Tariffs are the symptoms. Trade fragmentation is the real story. This slide highlights two important market signals happening at the same time. China plus one on the real economy side and gold on the financial side. We'll start with China plus one. India is selectively easing FDI norms for Chinese suppliers, mainly in areas where local capabilities are still thin. At the same time, India is funding domestic manufacturing and phone enclosures and PCBs to reduce long term dependence. So, this is not a reversal of China plus one, it's a more practical version of it. Meanwhile, global frictions are rising. Mexico's new tariffs are disrupting connector economies, and India has imposed fresh duties on Chinese steel to protect strategic sectors. The outcome is a supply chain that is more diversified but also more expensive and less predictable. Now, look at gold. Gold prices have hit a new global peak of around $4,400. Central banks are part of the story. India's RBI added roughly $2.96 billion worth of gold to its reserves, signaling a preference for hard assets in uncertain times. Tariff uncertainty, trade fragmentation, and geopolitical risk are pushing investors towards safety. The takeaway is simple: China plus one is reshaping how goods are made. Gold is reacting to the uncertainty created during that shift. They are different markets but driven by the same underlying force. A world moving away from the smooth globalization towards strategic risk aware trade. Now, the next presenter will take you to the further topics.
Moving forward to our next theme, let's talk about India's PLI schemes and how they are evolving into a full ecosystem engine. The production linked incentive or PLI initially focused on boosting assembly operations, but now it is shifting towards building a deeper domestic component ecosystem. In electronics, particularly high performance segment like smartphones, India has achieved cumulative iPhone exports of $50 billion with 16 billion in just FY26 from April to December. The focus is moving from simple assembly to encouraging local production of key components such as PCBs, camera modules, and enclosures. For example, Madari on electronic components has been approved for PLI, planning an investment of around 1900 crore rupees and creating over 5,000 jobs in Tamil Nadu. Some sectors like ACC battery are facing production delays due to supply chain constraints for critical raw materials such as graphite. The government is reviewing PLI rules to support producers in overcoming these hurdles. In textiles, new man-made fiber and technical textile units have started production, aiming to boost high-value exports and reduce dependence on Chinese polyester imports. The sector targets $100 billion in over 5 years with current exports of around 733 crore rupees. The PLI framework is evolving from version 1.0 to 2.0, shifting from silo assembly integration to deep localization. Domestic value added targets have increased from 35 to 40%, and stricter mandates are being implemented to build resilient domestic supply chains. The core principle ties incentives to meaningful ecosystem led investments rather than just assembly, directly addressing the screwdriver economic critique. The impact is already visible through high export growth, supply chain integration, and real cash payouts, confirming the operational viability of the schemes. With the understanding of how PLI is maturing, I'll now hand over to the next speaker who will continue further with the detailed updates.
Moving on to our market theme, decoding the Sensex and recent cuts. The Sensex is India's benchmark index representing the top 30 companies and acting as a barometer for market sentiments. It reflects how macro trends and liquidity flows influence behavior. Historically, December is a strong month for stocks, but this year was an exception, with the Sensex declining slightly by 0.2%. However, the real story is who was buying or selling. Foreign investors sold approximately 11,830 crore rupees worth of stocks. In contrast, domestic institutional investors injected a massive 59,900 crore rupees. Think of DIIs as a shock absorber. Without this massive domestic support to absorb the foreign selling, the market likely would have crashed significantly. On the monetary side, rate cuts and liquidity measures are tools used to support growth while maintaining inflation stability. The RBI has been aggressive, cutting the repo rate by a cumulative 125 basis points in 2025, bringing it down to 5.25%. This was driven by low inflation of just 0.7%. However, don't expect this to continue. Expectations for further cuts are low as headline inflation is expected to start rising again. Beyond rates, the RBI has actively injected liquidity using foreign exchange swap auctions and open market operations. Let's understand that in this way, if the economy is an engine, rate cuts are like easing off the brakes, while liquidity injections are like pumping in more fuels. The RBI is doing both to ensure the engine runs smoothly despite global headwinds.
Let's understand rupee. Over the last few weeks, the rupee has slipped to record lows of around rupees 90 to 91 against the dollar. While this sounds worrying, it's important to understand that this is not a currency crisis, but a result of broader economic and global factors. The main pressure on the rupee is coming from weak capital inflows and continued foreign investor outflows. At the same time, global uncertainty, especially around US trade policies and a strong dollar, have made investors more cautious. Slower nominal GDP growth has also reduced the returns global investors earn in dollar terms. That said, India's fundamentals remain relatively stable. Our balance of payments is comfortable, helped by strong services, exports, and steady remittance inflows. In fact, on a real effective exchange rate basis, the rupee has moved from being overvalued to undervalued, which actually improves India's export competitiveness. The RBI's approach has also evolved. Instead of trying to defend a particular exchange rate, it is allowing the rupee to adjust gradually, stepping in only to prevent excessive volatility. Looking ahead, a meaningful recovery in the rupee will depend on stronger corporate earnings, a revival in equity markets, higher FDI inflows, and clarity on India US trade talks. So, overall, the rupee's weakness reflects a necessary economic adjustment, and if managed well, a gradual depreciation can actually support long term growth. Now, let me quickly walk you through what India's key economic indicators are telling us. To start with growth, India continues to be one of the fastest growing major economies. In 2025, GDP growth was close to 7.5 to 8%, and even for FY26, growth is expected to remain strong. What's important here is that this growth is largely driven by domestic demand rather than exports. If we look at industry and manufacturing, the picture is mixed but still positive. Industrial output touched a 2 year high, and manufacturing PMI stayed comfortably in expansion. At the same time, export demand has softened, which has slowed momentum a bit. Domestic consumption, however, continues to support production. On the consumption side, household spending is clearly driving the economy. More than half of retail loans are now consumption related. Household debt has risen, but at around 41% of GDP, it is still at manageable levels compared to other emerging markets. Inflation has remained under control through most of the year. Prices stayed close to or below the RBI's comfort level, which has allowed the central bank to remain cautious rather than aggressive. From a fiscal point of view, the government finances are largely on track. Capital expenditure continues to play a crucial role in supporting growth, especially since private investment is still recovering. Overall, the indicators point to an economy that is growing steadily and remains stable, but one that is still heavily dependent on consumption and government spending, with private investment and exports being the key areas to watch going ahead. Thank you so much from all of us for watching our video.